Welcome back to the Bitcoin Layer. I'm Nick Bhatia here with another global macro update. Today we're going to look at the Bitcoin price rates, think about Bitcoin versus gold, and of course think about the path of the US economy and how that is going to affect risk markets, including stocks and Bitcoin. Let's get started with this chart of Bitcoin funding rates. When we talk about funding rates, what we're talking about is leverage. What is the price that leverage longs are paying to enter positions? Another way to think of it is, what are the longs paying to borrow money for synthetic long positions in the market? This is a measure of speculation, and a rising funding rate or an elevated funding rate is evidence of leverage. A falling funding rate is evidence of leverage coming out of the market. Now, with the Bitcoin price, what we want to see is leverage entering the market, but regulated, meaning that it's not getting out of hand. And with modest leverage, a bull market can sustain itself. With over leverage, that leverage is going to end up coming off, and those longs will close out, and that it's really an artificial component of the demand. That artificial component to the demand will taper off, and that will affect the price. We lead into funding rates with the volatility of Bitcoin, and I'm talking here about historical volatility. This is realized volatility, or backwards looking measure of price movements and how much the Bitcoin price is moving on a day-to-day basis. And what you can see from this long-term volatility chart on Bitcoin is that in 2025, we are in all-time structurally low volatility environment for Bitcoin. It means the Bitcoin price is not moving anywhere close to what it used to on a 30-day rolling period. And you can see that, yes, in the year 2023, for example, Bitcoin's volatility was more or less similar to what it is today, but the structural volatility of Bitcoin continues to decline. We believe that's a result of the maturing of the asset class. Now, quiet volatility in Bitcoin is not something that we can just bank on forever, especially because Bitcoin has this embedded volatile nature as people learn what the asset class means versus other asset classes. With Bitcoin's quiet volatility right now, we are starting to think that it's going to precede some larger move, really, as the market has found some balance or equilibrium between 100 and 120,000 or so. Now we can bring in the funding rates. You see the funding rates there in green and red at the bottom of your screen, and the Bitcoin price in orange. Now you can see that over the summer, we got a little bit of a wave of leverage. This is funding rates coming off of zero and staying a little bit elevated for the last few months. Now they're starting to come off. This means that leverage is coming out of the market. Now, when leverage comes out of the market and volatility is low, what it does is sets up for an environment with larger funding rates, meaning an increase in leverage leading to larger price movements. So Bitcoin right now at this $112,000 area, and we're recording this here on Wednesday, September 24th. The block height is 916,269. The Bitcoin price is at about $113,000 as we speak. So Bitcoin right now, its price is definitely at a crossroads. There's a large area of support between the mid 90s and the mid 100s, but Bitcoin is definitely sitting above that. So when I look at the support on the chart, I see somewhere between 95 and 105. Well, Bitcoin at around 113. It means that not only are you elevated from the support, but it's not that far away from it. So I am looking at this 105, 108,000 area as quite important for Bitcoin. I would like to see it hold, because if it doesn't, a trip back down to maybe the low 90s could be in the cards for Bitcoin. I say all of this to set up here, a decline in funding rates means that it's less expensive to take out a leverage long. And that sets up well for the Bitcoin price going forward. But yes, Bitcoin is a little bit above its support right now, its trend support. So there's a little bit of a pocket there that might be tested with Bitcoin. Now, if you are watching TBL liquidity, which you guys know that we watch very closely, our own metric that's based off of global macro factors in the bond and currency markets, TBL liquidity has started to gather a little bit of momentum. This is a bullish, supportive fundamental for Bitcoin, given the macro backdrop. We also look to see high correlations between Bitcoin and the stock market, which we currently do, and strength in the stock market, which we currently do. So these are supportive fundamentals for the Bitcoin price. TBL pros are able to get TBL liquidity data on a daily basis. So go to thebitcoinlayer.com/subscribe and become a TBL pro today and gain access to TBL liquidity and our TBL liquidity indicator. I'm going to show you the gold price a little bit later in this video, but I wanted to start with the Bitcoin to gold ratio. This is something we've started to watch a little bit more closely at your request because Bitcoin and gold are both performing magnificently over the last 12 months, and gold's performance relative to Bitcoin. Now, it hasn't outperformed Bitcoin trailing 12 months, but its performance relative to Bitcoin has raised a lot of eyebrows. I'm going to get back to this Bitcoin versus gold chart, but I want to show you those returns. Bitcoin right now, this is a chart that shows you if you started with $100 12 months ago, what would your return be today? So 100 to 174 for Bitcoin, it means a 74% trailing 12-month performance, gold 42%, stocks at 15.8%, and treasuries slightly below the zero line at about negative 3% on a total return basis going back 1 year. Now, looking at the Bitcoin versus gold ratio, what this does is it takes dollars out of the equation. You're changing the scale, you're changing the way you measure gold here by comparing 1 BTC to 1 ounce of gold. And how many ounces of gold would it take to purchase 1 Bitcoin? Well, today it's at around 30. Now, the number 30 here has come off of a single-digit level after the year 2020, where it rose above this 10 level, meaning 10 ounces of gold for 1 Bitcoin. You can see that it actually hit this level in 2017 for a few days, but sustainably eclipsed this level in 2020, 2021, and has stayed above there. Now, to go to the next order of magnitude, which would be 100 ounces of gold for 1 Bitcoin, we might take several years. On the other hand, it might happen more quickly than that as we look at this relationship evolving and Bitcoin taking that step from 0.1 ounces of gold for 1 Bitcoin to 1 to 10 to 100, just as we've gone from 10 cents to $1 to $10 to $1,000 to $100 to $1,000 to $10,000 to $100,000, and we have our eyes set on $1 million, we should also have our eyes set on 100 ounces of gold for 1 Bitcoin. Now, does this relationship also follow a power law similar to Bitcoin's age versus its price? Dr. Stephen Perrineau has showed us, yes, it does. We are going to continue doing our work there. I have built my own power law spreadsheet here on my trading desk so that I can get more comfortable with the numbers. We're going to do it versus gold. We're going to run the numbers ourselves because that's what a proper analyst does. And we're going to continue to bring you the highest signal information that we can. With all that being said, Bitcoin and gold have a very unique and historical relationship, especially because Bitcoin itself. And the way that it was designed was perhaps strongly influenced by the chemical properties of gold and the human relationship with gold and why we find it valuable. One final note on Bitcoin versus gold. I'm watching this chart much more closely on a zoomed in basis. There is an uptrend that has been in the works for the course of 2025. There is a support level around 25 that touched in April, and that level stretches back to around the level that we hit in September of 2024, which was around 21. So 21, 25, and then a bounce at around 29 or 30 would be very, very healthy for this ratio. That's something that we're going to watch, and definitely have to add this ratio into our arsenal, and especially for me on a price action basis, because Bitcoin and gold have live prices. That means we get candles, and from candles we can deduce behavior. You guys know all about James Check at Check on Chain, and you know that he's one of our favorite analysts to go over what is going on in the Bitcoin market. And in Checkmate's opinion, the consolidation between $75,000 and $115,000 is evidence of a maturing market. Go to unchained.com/TBL to register for this event. On September 30th, James and the Unchained team will go through why ETFs are bringing more institutional allocation to Bitcoin and why this current consolidation is evidence that the Bitcoin market is building strength underneath it. This session is designed to help you understand what this bull run means for Bitcoin. Register now for access to a new on-chain metrics report from Check on Chain at unchained.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archLending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. Let's switch over to interest rates. Thinking about the Fed cutting rates, thinking about the US economy, and thinking about the Fed's mandates. It has a mandate to tame inflation. It has a mandate to support employment. It also has a mandate for financial stability. And of course, it is chartered by the US government itself and therefore responds to the legislative and, to a lesser extent, the executive branch. Now, Bitcoin has responded to Fed policy. We know that over the last decade, but it's not that the Fed cuts and Bitcoin goes up. It's not a one-to-one relationship. It's more the dynamic that the Fed provides to the market, which is an expansionary credit impulse. And when the Fed lowers rates, what it's doing is it's cheapening the cost of borrowing in the front end of the curve, but it cannot influence the longer end of the curve, which is dominated by growth and inflation expectations. So when the Fed cuts rates, short-term rates should go down or have already gone down in anticipation, but long-term rates, it could actually pop those rates, meaning send them higher, as a cheaper cost of funding today leads to a higher growth and inflation expectation in the future. This should, on the margin, steepen the yield curve, and that's what we are going to look into today. Is the Fed steepening the yield curve, and what is the Fed responding to? Here, we believe the Fed is responding to a weaker labor market for sure, but in reality, it might be responding a lot more to that 1913 aspect of the Federal Reserve, which is the fact that it was created by the US government. The independence of the Fed has been called into question a lot over the last few months, with the president challenging the Fed chair to lower rates. But we can see that the Fed chair has eventually caved to the president, started to lower rates, and has pinned it on the labor market. So, what are we to believe? Well, whether or not the Fed chair has responded directly to the president and lowered rates, we do have the context of how the Fed behaved with the US government during World War II in the 40s. We know that the government was supported by the Fed as the Fed basically anchored interest rates by promising to buy and sell notes and bills to anchor those yields quite low to enable the government to deficit spend and fight the war with a big military industrial complex building up here. So that happened in the 40s. For it to happen again wouldn't be foreign to the US. In fact, in 2020 and 2021, during the pandemic response, we saw the Fed buy trillions of dollars of treasuries that was pure deficit spending in an emergency response from both right and left sides of the aisle as the pandemic stretched across the Trump and Biden presidencies. Now let's look at the chart of the 2-year yield. You can see a clear downtrend since 2023. Rates are going lower. They will continue to go lower as the Fed backs off of this overly restrictive rate to respond to demands by the government to cheapen the borrowing cost for the government in the front and medium end of the curve. The Fed is, with its own desire to cover itself, attributing this to weakness in the labor market. But really what we think about is that the GDP, real GDP is at 3%, nominal GDP is at 6 to 7%, inflation is still at 3%, far above the Fed's original 2% goal. The Fed has said we're going to support the government in its desire to lower its borrowing costs, and at the margin we're going to get rates a little bit lower for the bills side of the curve, and we're going to look at bills a little bit closer. But this is really key for the government to get its borrowing costs down, especially with these very, very large peacetime fiscal deficits of 6 to 7%. So we look for twos to continue to go lower. And in our next chart, we look at the 30-year yield. Well, what has the Fed cut done to the long end of the yield curve as it sent inflation expectations soaring? Not really. The 30-year part of the curve continues to trade near 5%, but not really threatening it today, and not threatening it as a result from the Fed deciding to get toward neutral, which is somewhere in the low 3% and lower rates. I want to look real quickly at contributions, the contributors of yield. So in purple at the top, you have the 10-year yield. And in red and green, you have the contributors. So the red plus the green line equal the purple line. That green line is the real yield. This is a traded yield. TIPS, this is the inflation protected yield. And the red line is a calculation that basically takes the nominal yield and lesses or subtracts the TIPS yield. That 2.38%, it's called inflation break even. It means that if you were to buy TIPS today, you would get 178. If you were to buy 10s, you would get 416. And that difference of 2.38% is what you are assuming the inflation protection will be from the TIPS instrument. So if you buy TIPS at 1.78, you are assuming that you will get 2.38 as your inflation kicker to that bond. The reason that you assume that is because if you didn't, you would be buying, let's say you expected that inflation would be 1%. So you would get 1.78 plus 1%. If that's what you think, you would buy 10-year yields at 4.16 because you would be getting 4.16 over that life versus 2.78, which is that green line plus 1%. What I'm trying to explain to you guys is this is a break-even market, and the market is telling us that the assumption for inflation over that 10-year time horizon is 2.38%. That's not a lot. It doesn't mean that there's a lot of inflation baked into the market, and real yields declining over the past few months suggests that getting inflation at 2.38% is coming with demand, meaning there is demand to get that 2.38% inflation break-even yield that's baked into the TIPS market today. It's sending TIPS demand higher. That means inflation protection higher and sending those real yields lower. I think this is evidence of strength, underlying strength within the Treasury market, and something that I take a lot of signal from. A quick peek at the MOVE index, which all you pros out there will know is a big part of our TBL liquidity index. MOVE has gone lower and lower. Yes, there was a spike during the early parts of September, but it came back down. The Treasury market is right now seeing some decent strength, low volatility, and good conditions for credit creation. It's no wonder that our TBL liquidity metric right now is showing supportive signs. Let's take a look at the US dollar. This is DXY. This is an index that we watch quite closely. It's the dollar versus other fiat currencies, predominantly the euro and the yen. The dollar has moved lower in 2025. That's been very supportive to liquidity and risk assets. It's a move that we noted and we were watching every step of the way. We also saw it bottom this summer and form a little bit of a base. Now the dollar, if it chops around this low level, we feel that's very supportive for liquidity. As long as the dollar is not moving up and moving up in a very rapid way, all quiet on the Western front in capital markets, and volatility will continue to be low, and that will support markets. Now, what is a big wild card, aside from the dollar gaining some strength here and bouncing and posing a challenge to liquidity? A wild card is the dollar breaking down even further, maybe not in 2025, but in 2026. If that can happen, it will probably be driven by policy. And by policy, I mean not only trade policy, but Fed policy, cutting rates, supporting the economy, and supporting the idea that the dollar doesn't have to be overly strong. It can actually, the US can actually dictate the dollar to go lower, as it did in 1985, the Plaza Accord. We have to keep in context the history of how the government, the US government, treats the dollar, and specifically a strong dollar. It responds to a strong dollar by introducing policy to weaken the dollar. And that's something that we'll continue to watch for in 2026 and could be an enormous boost to liquidity. We're still wrapping our heads around the idea that the economy, the US economy, that entered this very rapid and protracted recession during the pandemic might be resetting slowly and coming out of that reset only now in 2025 and heading into the early parts of a new expansion in 2026. Could that be the case? We're starting to think that it is. And so if that is the case, we would expect that to be accompanied by and even partially driven by a weaker dollar. So all eyes on the DXY for us. The last chart I'm going to show you today is Treasury bills as a percentage of overall Treasuries outstanding. That percentage you can see on the bottom pane, and the two nominal amounts there on the top pane, bills in blue. Today, bills at about 21.7% of overall Treasuries outstanding. This is relatively low compared to where it was 2 decades prior, but yes, higher than it was last decade. Now, if the Treasury Department can continue to hit the market with bills and rates are going a little bit lower, this will help the borrowing situation as long as the fiscal deficit isn't blowing out. So we have to account for bills as a percentage of Treasuries, but also the deficit as a percentage of GDP, tax receipts as a percentage of GDP, interest cost or the interest burden as a percentage of overall tax receipts. These are all the variables that we must watch to see how the Treasury market is doing. It's our opinion that the Treasury and the government can move around the Treasury supply and the issuance enough to support coupon issuance and prices all the way out the yield curve, meaning they don't have to issue that many 30-year bonds, and because they don't have to issue it, they won't threaten much higher interest rates in that part of the curve. That's going to be a big part of their policy. But the main goal of the US government cannot be on the borrowing side or the deficit side. It has to be on the revenue side. The deficit side, as long as they are controlling the runaway deficits that they had, raising revenue, and as Secretary Bessent said, running it hot is the only way that the US government can achieve some sustainability on its debt picture. We are of the opinion that the sustainability of Treasury issuance a decade out, even with massive fiscal deficits, will be supported by a combination of the Fed, the US banks through deregulation, SLR reform, other recollateralization efforts with deregulation and Bitcoin coming onto bank balance sheets. There are a bunch of ways that the US can recollateralize and have a very broad economic base from which to pay back its debt that it has borrowed and outstretched the current GDP by about 20 to 30%. That can only fall if GDP rises, and GDP can only rise if the productive capacity of the country continues to grow. It's also a result of what we anticipate to be a lot of economic statecraft on behalf of the United States to respond to the rise of China over the last 3 decades. Thanks for sticking with us today at the Bitcoin Layer. I'm Nick Bhatia. We'll catch you guys next time.